Sorry, I just want to add. Yeah, I mean the capital. We're talking about the price earning thing. The Schiller index. Um,
I'm not
the
sure I
other
know
the other
much about it.
side the other side of the equation, of course, is earnings. And if you have a few years of strong growth, then company earnings are going to rise as a result, which will mean that the ratio goes down compared to where it was, where it's the last couple of years you've had a pretty significant. I mean, it's been short, but it's been fairly significant recession. So I think that will help to adjust some of the figures. Um, the other point is, and I mean, the US market rises have been quite concentrated. A certain number of relatively few stocks, like Tesla, which and um, and some of the others big tech stocks, which now I think comprise about 20% of the market. Um, and so that I think affects how things are viewed on some of these metrics. And I think the final point I'd make is increasingly these the performance of these stocks is based upon their ownership of a part of the economic rent, and that gets capitalized into a price, not necessarily commensurate with the amount of earnings. So I think some of these metrics themselves are increasingly misleading if you're comparing them to, say, the levels they were at when you had a much more heavy industrial based economy in the 1920s, which is often what they say. Oh, the markets are priced as high as they were in 1929, so going to come crashing down. I think that, you have to understand economic history before you make sort of you take some of these relatively simplistic measures of valuation.
Yes, I think that's a very important point. Very well stated, and that will be missed by most commentators. They don't determine their models don't determine economic rent, and the capitalization of the economic rent can be done at higher multiples because it just gets enclosed. So I agree. The comparison with former times may not be that relevant any longer.